A billion-dollar war chest designed specifically to tame the inherent stomach-turning volatility of the crypto market.
Yeah.
Is this the apex of sophisticated financial innovation, or are they just building a highly intricate, highly leveraged house of cards?
Well, that is the central paradox, isn't it? It's what defines Strategy Inc. right now. They are, arguably the world's most aggressive Bitcoin maximalist institution.
Right.
Yet their entire model for survival and growth is built on capital from the oldest, most traditional parts of finance. We're talking structured debt, high-yield preferred stock, and critically, this massive reserve of cold, hard U.S. dollars.
And that dichotomy is exactly why we're here today. I'm Satosha.
And I'm Satoshi.
Okay. In the high-stakes world of corporate finance, Strategy Inc., and we'll get into the rebranding in a moment, has made a move that could fundamentally redefine how Wall Street even looks at Bitcoin exposure. They've set up this massive $1.44 billion cash reserve. And this money isn't just sitting there. It's acting as a bridge, a secured 2-year-long bridge from the old world of fiat currency to the volatile new world of digital assets.
And that transition, it marks a profound shift. I mean, they're no longer simply a company that buys and holds Bitcoin. They've legally and structurally become what they actually call the world's first and largest Bitcoin treasury company.
And their main tool for this, the thing that attracts all this traditional capital, is something they've created called digital credit.
Digital credit, yeah.
It sounds proprietary, maybe even revolutionary, and I guess in corporate finance it really is. The core idea is that Strategy Inc. borrows money from the traditional system.
Right.
Things like debt and preferred stock that have specific cost, and then they immediately use that cash to hoard Bitcoin. It's just a massive institutional scale arbitrage bet.
And the math behind that bet is startlingly simple, even if the execution is incredibly complex. They are betting that Bitcoin's long-term appreciation will just massively outpace the cost of servicing all that fiat capital.
And that cost is high. We're talking, what, 10, almost 11% on some of their preferred stock?
It can be, yes. But then it's remarkably low, almost 0%. On their convertible debt. So the $1.44 billion cash reserve is the shock absorber. It's what makes this whole highly leveraged bet, palatable to conservative investors who otherwise wouldn't touch crypto with a 10-foot pole.
Right. So they built what numbers show is basically a 21-month financial fortress, a reserve specifically engineered to let them weather any crypto winter without having to panic sell their Bitcoin holdings.
And those holdings are staggering. Last we checked, they were approaching, 650,000 BTC?
It's nation-state level accumulation.
It really is. And it's essential here, especially for our listeners who followed our last deep dive on them, to connect this new cash reserve to their original capital structure. The response we got to that episode was overwhelming, especially about the mechanics of their preferred stock, STRC.
That was the episode where we broke down the structural integrity, yeah.
Exactly. We did that complex waterfall modeling, and our analysis showed that the original structure was robust enough to protect STRC even in a severe market crash. Specifically, our model proved that STRC was protected down to a Bitcoin price of around $18,000.
Which at the time felt like a monumental piece of financial engineering. It showed they were thinking cycles ahead of everyone else.
Right. The $18,000 figure was the theoretical failure point of that initial structure. The crucial takeaway today is that this new $1.44 billion reserve doesn't just add liquidity, it dramatically extends that safety net. It ensures the whole thing holds together by effectively prepaying almost 2 years of obligations. It raises the stability floor way above $18K.
And that brings us to the mission for this deep dive. We're going even deeper. We need to understand the engine. How do they raise this massive pile of cash? What does it mean for their, ridiculously complex menu of different stock classes? And is this whole thing sustainable through a long downturn? What does this revolutionary digital credit model mean for the rest of corporate finance?
It really is a study in ambition and complexity. They're basically running a sophisticated asset management company that's disguised as a software vendor. It's a machine built to funnel fiat capital directly into digital assets.
So before we jump into the details of that transformation, we just want to welcome you again, our listeners, and say thank you for the tremendous response to our content. We're seeing a ton of engagement, especially on our last deep dive on the value function. And it's clear you're all as fascinated by these deep dives as we are.
Your engagement, the critiques, the questions, the way you dig into our sources, it's the absolute fuel for this show.
It really is. And to keep producing this level of content and to start creating high-quality companion videos to visualize these structures, and trust me, you're going to want to see a chart for this one. We need your help. We're trying to unlock funding for a Mosaic AI video editor by hitting 1,000 subscribers on all platforms.
So please, if you enjoy these discussions,
take a moment, hit subscribe on YouTube Music, Spotify, Apple Podcasts, wherever you listen. Every single one counts.
Okay, let's get into it. The transformation from software company to digital treasury giant.
All right, let's unpack this. MicroStrategy Incorporated, the company most people knew, did a full legal name change and a rebranding to Strategy Inc. We've seen all the tickers changing, STRF, STRC, STRK, and so on. This isn't just marketing fluff. It's a definitive legal move.
It's completely strategic. It aligns their corporate identity with their new explicit mandate. They are, in their own words, the world's first and largest Bitcoin treasury company and an issuer of digital credit. The name now reflects what the business actually is.
I find that shift from MicroStrategy to just strategy so telling. Dropping micro elevates them to this macroeconomic scope. They're positioning themselves not as a tech company, but as a macro hedge instrument for institutions.
Precisely. The name Strategy reflects their one single corporate goal: maximizing Bitcoin per common share. The alt software business is still there. Sure, it provides some cash flow, a legal foundation.
A wrapper.
It's a wrapper, exactly. But the market's valuation, the company's entire destiny, is now tied to the success of its Bitcoin treasury. This name change just mirrors their ambition to be a key part of the global financial system, a bridge between old fiat capital and new digital assets.
So let's circle back and really define this core concept, digital credit. We know it's about leverage, but how do we frame it for someone who's just used to normal corporate debt?
I think the best way is to think of Strategy Inc. as a financial transformer, a sort of specialized bank for the digital age. They systematically go to the largest, most traditional, slow-moving pools of fiat, capital pension funds, insurance companies, wealth managers, and they borrow that currency at a known cost.
A cost that varies quite a bit, which is part of the genius. You see these high yields, 8–10% on their preferred stock, but then these like 0% convertible notes.
Correct. So they absorb all that capital, they immediately convert it to Bitcoin, and they hoard it. They're basically pulling a massive chunk of supply right off the market. And the entire financial structure is built on one simple bet: that the price of Bitcoin will grow much faster than the cost of servicing all that debt.
And the ultimate goal isn't just to own Bitcoin. It's to use this borrowed money to increase the amount of Bitcoin per common share of MSTR. So the common stockholder is okay with the dilution and complexity now because they're betting the leveraged BTC stack will be worth it in the long run. But let me push back on that because this is where the MSTR shareholder feels some pain. Strategy Inc. just spent $1.4 billion in cash to secure this structure. And that cash was raised by selling common equity, by selling MSTR. Isn't that totally counter to their goal? They're sacrificing Bitcoin accretion now for stability later.
That is the essential trade-off, and management is very clear about it. They call it a necessary insurance premium. They argue that, yes, selling equity is dilutive in the short term, but the alternative, the risk of the whole structure collapsing in a downturn and forcing them to fire sale their entire Bitcoin stack, is way more destructive.
So the reserve ensures survival.
It ensures the survival of the platform. They're using capital from stability-seeking preferred shareholders, secured by this cash buffer, to enhance the long-term holdings for the aggressive growth investors by getting rid of that forced sale risk. It's a high-wire act for sure, but a very deliberate one.
A powerful justification. Framed as survival, not a luxury.
Absolutely.
Okay, let's pivot to the absolute star of their capital structure. STRC, or the Stretch Preferred Stock. They have a whole menu of these things, but STRC has this unique, almost custom-built mechanism that's really caught the attention of Wall Street.
It is a highly innovative financial instrument. It's basically short-duration, high-yield credit. It's designed for a very specific type of investor, someone who wants principal stability, predictable cash flow, and tax efficiency above all else.
And what's the yield that's pulling in all this capital?
Recent filings show it's been hovering around 10.75% annualized. That's a huge income stream in this environment. But like you said, the yield isn't even the most innovative part. It's the mechanism they use to control its price.
Tell us more about that, the monthly adjustment feature. How does that strip out volatility?
This is the genius part of the engineering. STRC's dividend rate gets recalibrated every single month. So unlike a traditional bond or preferred stock that gets hammered when market interest rates go up.
Because its fixed coupon becomes less attractive.
Exactly. STRC's dividend just adjusts. It's designed to always encourage the security to trade right around its $100 par value.
So if the Fed were to hike rates tomorrow, STRC would just increase its dividend payout next month to stay competitive.
Precisely. If other similar credit instruments start yielding 11%, STRC's rate will adjust upward to match. This mechanism effectively strips away what's called duration risk, the price volatility that comes from changes in interest rates. So an investor gets high, stable income, and their principal doesn't get destroyed by the bond market.
It's like a supercharged money market fund, but with a very different kind of collateral risk underneath it all, Bitcoin volatility. And that monthly payment is so attractive to retail income investors.
It creates a sense of predictability that's backed by an inherently unpredictable asset. That's the magic trick.
Okay, now for the real kicker. The structural advantage that makes STRC so magnetic, the return of capital, or ROC, classification for its dividends.
This tax treatment is this. It's critical. You can't understand why so much money is flowing into this without understanding ROC.
So explain it simply for our listeners. How is it different from a normal dividend?
Okay, so with an ordinary dividend, you get the cash, you pay ordinary income tax on it right away, could be as high as 37%. But if a dividend is classified as return of capital, ROC, you don't pay tax on it now. Instead, the dividend amount just reduces your cost basis in the stock.
So if I buy STRC for $100 and I get $10 in ROC dividends over a year, my new cost basis is just $90. I basically just deferred my tax bill.
You've deferred it, exactly. The tax is legally pushed off until you eventually sell the stock, which could be years down the road. It's a massive, powerful benefit for tax optimization.
And you can see how this would appeal to certain people. High earners trying to manage their tax bill for the year, or someone nearing retirement who wants to push that tax event into a future year when their income is lower.
Think about it. If you're in your peak earning years now, but you expect to be in a much lower tax bracket in 10 or 15 years when you retire, you can use STRC to get high income today, but only deal with the tax consequence later. And if you hold it for more than a year, that tax might even be at the lower long-term capital gains rate. It's incredibly powerful.
But why do they even qualify for this? Most profitable companies pay ordinary dividends. Don't they have massive unrealized gains on their Bitcoin?
But that's the nuance. RSC classification doesn't depend on cash flow. It depends on a company's earnings and profits, or E&P, which is basically its taxable income.
Okay.
And Strategy Inc.'s core business is holding Bitcoin for the long term. Unless they actually sell that Bitcoin, which would trigger huge taxable gains, the holding itself doesn't produce enough recurring taxable income to cover the massive dividend payments.
So even though they have this giant valuable asset, the lack of recurring taxable income from it means their dividends get classified as a return of the investor's own capital.
That's the structural reality, yes. They get some income from the software business, sure, and now interest from the cash reserve, but it's not nearly enough to convert the, nearly $300 million a year in STRC dividends alone into ordinary income.
Which leads right to the question of the new reserve. That $1.44 billion is sitting in T-bills, earning interest. Is that income going to eventually change the ROC status?
The sources suggest the dividend burden is just too high. While that interest income helps liquidity, it's highly unlikely to be enough to cover the total annual dividend obligation of over $700 million. So no, it doesn't really change the tax math. The ROC classification should stick around as long as their primary business is holding Bitcoin.
All right, so now we get to the centerpiece, the bedrock that makes all of this work, the $1.44 billion USD reserve. The financial fortress, Strategy Inc. calls it the cash wall, or the moat, and its creation fundamentally changed the risk calculation for anyone holding their fixed income products. So first question, how did they get $1.5 billion in cash without selling any Bitcoin?
They used a very sophisticated mechanism called an at-the-market, or ATM offering. They sold newly issued shares of their common stock, MSTR, and this whole thing only works because of what the market gives them. the strategy premium.
Explain that arbitrage. Why does the market give them this premium, and how do they turn it into cash?
So MSTR common stock almost always trades at a significant premium to its underlying Bitcoin net asset value, or NAV. If you calculate the dollar value of the Bitcoin they hold per share, the stock price is usually much higher.
But why? Why wouldn't I just buy a Bitcoin ETF at NAV instead of MSTR at a 30% premium?
It's a great question. The premium exists for a few key reasons. One is scarcity and governance. They offer institutional-grade access to a huge, leveraged Bitcoin treasury. Two, they can access debt markets that a pure crypto company can't. And three, that software business acts as a legal wrapper, letting them avoid being regulated like an investment trust. The premium is what you pay for the structure, the leverage, and the governance.
I see. So Strategy Inc. is literally monetizing the market's appreciation for its structure. They sell their high-premium MSTR stock to grab pure USD cash. They're harvesting the premium.
Exactly. They're harvesting the market's overvaluation of their equity to raise cash at, effectively, a negative cost relative to their NAV. And then they use that cash to service the obligations on their preferred stocks, which trade at or near par value. It's a brilliant way to lower their overall cost of capital.
Selling a leveraged growth vehicle, MSTR, to secure a stable income vehicle, STRC.
And this cash has a single crucial purpose. It's a shared liquidity pool meant to cover all preferred dividends and all debt obligations. It's a universal backstop for everything except the common stock.
And what's the explicit function of this cash wall, besides just paying the bills?
Its purpose is to completely decouple their fixed obligations from short-term Bitcoin price volatility for almost 2 years. If Bitcoin crashes hard, say down to $20,000, capital markets could just freeze up. Without this reserve, they would be forced to panic sell BTC to make their payments. This reserve guarantees they don't have to sell their core asset at the absolute worst time. It kills liquidity risk and forced sale risk.
And time is the most valuable asset in a crypto winter. Okay, let's walk through the simple math of this 21-month fortress.
The math checks out. First, you have to look at their total annual financial obligation, all their debt interest, all their preferred dividends. It comes out to roughly $731 million a year.
Let that sink in. $731 billion a year in fixed payments. It's a massive operation built on a non-yielding, volatile asset. The fixed cost is enormous.
It is, and if you break that down, the STRC dividends are the single biggest piece, at about $294 million a year. But in contrast, the interest on their 0% convertible debt is tiny, only about $35 million. So the vast majority of their cash burn is just feeding the preferred dividend structure.
So we take the $1.44 billion reserve and divide it by the monthly obligation.
Yep. The $731 million a year is about $61 million a month. So $1.44 billion divided by $61 million gives you about 23.6 months of coverage.
But management conservatively calls it 21 months.
Yeah.
Why the difference?
That's just them being prudent. They're likely factoring in a few things. They fully expect to issue more preferred stocks soon, which will increase the monthly bill. They also have to account for STRC's floating rate. If market rates spike, their cost goes up. And they're probably building in some operational buffers. 21 months is the stress-tested number.
But either way, the significance of 21 months in a cyclical market like crypto is huge.
It is. It historically exceeds the typical length of a Bitcoin bear market. By securing payments for almost 2 years, they ensure the digital credit machine keeps running. It removes the market timing risk from the dividend equation, which is what validates the high yield for the preferred shareholders. They basically prepay the liability for an entire cycle.
Let me challenge that, though.
Yeah.
If this is a long-term bet, what happens on month 22 when the reserve is gone? Doesn't the whole structure just go right back to being at risk?
That's the core sustainability question. They've bought time, not a permanent solution. The assumption is that within those 21 months, one of two things has to happen. Either Bitcoin appreciates enough that they can raise new, cheaper capital, or the MSTR stock premium is still there, so they can just refill the reserve by selling more equity.
So if Bitcoin stays flat and the premium disappears, they've just kicked the can down the road.
They've just deferred the crisis by 21 months. It's a survival mechanism for one cycle, not a promise of perpetual life. That's a crucial distinction.
It is. Okay, let's look at the complexity of the capital structure itself. They've used all these different tickers to deliberately segment risk and tap into different pools of money.
It's a masterclass in financial targeting, really.
MSTR, the common stock, is for the pure, aggressive, leveraged Bitcoin exposure.
Yeah.
And it's also the funding engine for this whole thing.
Correct. MSTR investors are betting on appreciation and management execution, period. But the preferred stock menu is way more complex. They've engineered a choice for every kind of risk tolerance.
So let's contrast them, focusing on what determines the real risk.
Okay, we've covered STRC, variable, high yield, low duration risk, monthly payments. Now consider STRK, the strike preferred. This one is a fixed 8%, it's perpetual, and critically, it's cumulative.
Define cumulative for our listeners. This is where the real protection is.
Cumulative is a huge safeguard. It means that if Strategy Inc. is ever forced to suspend dividends, maybe the reserve runs out and the market is terrible, the unpaid amount just accrues. It becomes a liability. And they have to pay back every single missed dividend to the STRK holders before the common shareholders, the MSTR holders, can never see a dime.
So it's a legally protected IOU. Your right to that income is deferred, not lost. It's a true fixed income instrument.
Exactly. It's a critical safety net for conservative investors.
What about STRF, the stream preferred?
STRF is a bit higher at a 10% fixed rate, also perpetual, also cumulative. The interesting thing there is its sister security, STRE, which is denominated in euros. That's a hugely strategic move to tap into non-US capital, specifically conservative European wealth managers, and it lets them hedge some currency risk.
And then we get to STRD, the stride preferred, which is the highest risk because it's non-cumulative.
Yep, STRD also has that high 10% rate and is perpetual, but it's non-cumulative. If the board skips a dividend on STOD, that obligation is gone forever. They have no legal duty to ever make up that payment.
That makes it way riskier. Why would anyone choose that over a cumulative option?
For the yield, which compensates for that risk. But this is where you really see the importance of the 21-month cash reserve. For STRD holders, that reserve is absolutely vital. A cumulative holder can wait out a storm and get paid later. A non-cumulative holder loses their income permanently. The reserve makes a skipped payment statistically unlikely for the next 2 years, which gives those investors the confidence to chase that high yield.
And beyond the preferreds, they've been incredibly clever with their debt management, especially those zero-coupon convertible notes.
Oh, that's a highly sophisticated maneuver. The cash interest expense on those notes is only about $35 million a year. It's a tiny fraction of the preferred dividend cost, and it keeps their overall weighted average cost of debt incredibly low.
So these notes cost them almost nothing in cash flow right now. They get to use the money for free, basically.
In the short term, yes, it's free money, but with a big catch: future dilution. The debt only converts to equity if the MSTR stock price rises way above the conversion price. If and when it hits that threshold, the debt converts into a flood of new shares.
So the trade-off is stark. They avoid cash payments now, which protects the reserve, but they accept a massive equity hit later if their Bitcoin thesis actually works out.
That's the core strategic balance. They use extremely cheap, non-cash costing convertible debt right alongside very expensive perpetual preferred stock. It's a meticulously balanced hybrid, all designed to support the main goal: hold the Bitcoin indefinitely.
Okay, let's talk broader implications, starting with the immediate positive: credit rating.
The $1.44 billion reserve is unambiguously good for their credit. It materially improves their liquidity profile, which lowers the odds of short-term distress.
So where could their rating go? They started deep in junk territory, right?
Yeah, deep junk, like a B-. Plausibly, we could see them move up toward upper junk, maybe a BB or BB+. The sources suggest that in a best-case scenario, they might even inch toward lower investment grade, like a BBB-, and getting that rating would open up vast new pools of institutional capital.
But a leap to high investment grade, like an A-, is basically impossible. Why can't the cash cushion solve everything?
Because the company's fate is still tied to the volatility of Bitcoin. They don't have stable, recurring earnings from a non-volatile business that can reliably cover that massive $731 million fixed cost year after year, forever. The reserve is a 2-year buffer, not a fundamental change to the risk of their primary asset.
And this whole hybrid approach, aggressive BTC holding but conservative cash management, it also seems designed to boost their legitimacy with regulators, doesn't it?
Absolutely. Holding a huge pile of USD and T-bills instead of being 100% Bitcoin presents a much more conservative, risk-buffered balance sheet to the world. It enhances their credibility with investors, creditors, and especially regulators.
Makes a more palatable issuer of these digital credit products, especially somewhere like the EU, where they listed that STRC preferred stock.
It's a powerful combination, aggressive on digital assets, but conservative on treasury liquidity. That approach could really smooth over regulatory friction and strengthen their position as this sort of quasi-financial institution.
Okay, now for the most crucial part. Sustainability and the key existential risks. Nothing this complex is without some serious trade-offs.
The first risk, which we touched on, is that short-term dilution for the common shareholder. Funding the reserve by selling MSTR stock is, mathematically, dilutive to the BTC per share ratio.
And while management calls it an insurance premium, what happens if they have to do this every 2 years?
Well, if they're constantly selling equity to maintain the reserve, they are perpetually shrinking the common shareholder's claim on the Bitcoin treasury. It's necessary for survival now, but if they rely on it too much, it could eventually erode the whole reason people hold MSTR in the first place.
The second, and maybe more fundamental risk, is the reliance on the strategy premium.
This is the big one, the existential one. The entire model hinges on MSTR stock trading at a significant premium to its NAV. We talked about why the premium exists, but what happens if the market changes its mind?
So if Bitcoin enters a multi-year bear market that lasts longer than 21 months, and that stock premium just evaporates,
Then their ability to raise cash by selling equity vanishes completely. If MSTR trades at NAV or even at a discount, issuing new shares to pay dividends becomes instantly value destroying. The engine that refills the reserve breaks down. The perpetual existence of that premium is the single biggest point of failure in the whole structure.
so the whole thing relies not just on Bitcoin going up, but on the market's continuous belief that Strategy Inc. is a better way to get Bitcoin exposure.
Precisely. If, say, a huge super liquid spot Bitcoin ETF comes along with better tax efficiency, the market might just reevaluate MSTR's premium and it could shrink fast. The financial engineering only works as long as the market values the strategy wrapper.
Finally, as they act more and more like a financial holding company, they risk attracting the biggest regulatory threat of all, the Investment Company Act of 1940. We need to spend some real time on this.
This is the absolute biggest risk they face. That act was designed to regulate companies that are primarily in the business of investing or trading securities. If Strategy Inc. gets classified as an investment company, the consequences would be catastrophic.
What's the trigger?
The main test is whether they hold more than 40% of their total assets, excluding cash and T-bills, in passive investment securities. And given that the value of their Bitcoin vastly exceeds the value of their software business, they're always walking a very fine line.
But they maintain they're an operating software company.
They do, and they lean on the functional test, which looks at what the company does, but the rebranding, the focus on digital credit, issuing all these different securities, it strongly suggests they're acting like a de facto closed-end fund, and that might invite regulators to take a much closer look.
And what are the actual consequences? Why is this an existential threat?
They're immediate and severe. If they're deemed an investment company, they'd suddenly be restricted on how much debt and preferred stock they could even issue. It would force a massive deleveraging, potentially forcing them to sell Bitcoin immediately. They'd face huge limits on their structure, maybe even have to sell off the software business. It could also trigger a wave of shareholder lawsuits.
So the very regulatory system they're using to their advantage could be the system that dismantles them.
It's the highest risk because it's a systemic legal risk you can't hedge with a cash reserve. If it's triggered, it would require a complete teardown of their entire financial model. They are threading a very, very fine needle.
This has been a massive dive. I mean, Strategy Inc. has shifted from this all-in crypto treasury to a hybrid entity, balancing aggressive digital asset exposure with conservative cash discipline. It's brilliant.
And the research is conclusive on one point. For the fixed income investors, the structure is sound for the next 21 months. They have bought time, and time is protection against volatility.
Which leaves us with a fascinating question for you, the listener. Is Strategy Inc. creating the definitive blueprint for other companies to follow? Is this the first successful model that truly bridges the gap between the volatile world of crypto and the stability that traditional finance demands?
Or, on the flip side, are they creating a new kind of systemic risk? A single, highly leveraged, too big to fail entity in crypto whose collapse would send shockwaves through both the equity and fixed income markets at the same time.
It's really a community effort to track this story. Our analysis is based on public information, but this is all unfolding in real time. So we invite you, our listeners, share your own analysis in the comments. Are we being too optimistic about the 21-month cushion? Too critical about the MSTR premium? We want to hear from you.
And we're always looking for collaborators. If you're a finance expert or a crypto native with a sharp eye for these debt structures, or especially the nuances of the Investment Company Act of 1940, please reach out. We value the expertise in our community.
So as we close, let's leave you with one final provocative thought. The $1.4 billion reserve gives Strategy Inc. 21 months of time. But that time is expensive, costing them 8 to 10% a year. Given that their long-term thesis is that Bitcoin will demonetize other assets, what is the most valuable use of that bought time beyond just paying dividends?
Right.
Should they be aggressively building up non-BTC cash flows from the software business to create a real stable earnings buffer? Or are they right to simply weigh out the cycle, trusting that the thesis will play out within that 21-month window?
It's a core governance question. How should they leverage the time they just bought to make sure they don't have to do this all over again?
Something profound to think about.
Yeah.
As always, keep searching, keep the quest on.